Next, we will move to the Unit 2, Income from House Property. We will have a brief introduction about income from house property. Section 22 of the Income Tax Act 1961 deals with house property income. Income from houses, building, bungalows and godown are taxed under this head. Under this head, tax is not based upon the actual income, it is based upon the annual value, that is notional value hyphen imaginary value. Annual value of the building and the land attached to the vicinity of the building will be considered for tax under this head. Point to be remembered while calculating house property income. Any building and land attached to the vicinity of the building, any income from the building and the land attached or situated in the vicinity of the building will be taxed under this set of income. The term building includes mud walls, residential house, office building, cinema hall, public auditorium, etc. Assessee should be the owner of the property. It is only the owner who will be taxed under this head. Owner may be legal owner or beneficial owner. He may be an individual, firm, company or association of persons. Note, owner will be taxed if he is not in receipt of the property income. Property should not be used for assessee own business or profession. If the property is used for the assessee own business or profession, then it will not be taxed under the income from house property. It will be taxed under the income from business or profession accordingly. In case of dispute regarding title, the title of the ownership, then the beneficiary will be taxed. For example, if a property which is in dispute belongs to two persons, namely Mr. A and Mr. B, and Mr. A receives the rent from the tenant, then Mr. A will be taxed for the same since he is the beneficiary. If property let out along with other asset, if property is let out along with any other asset, then it should be taxed as follows. First one, if income from house property and income from other asset are separable. Income from property, tax as income from house property. Income from other asset, tax as income from other sources. For example, total income 2 lakh, property income 1,45,000, asset income 55,000. So income from house property is 1,45,000, income from other source is 55,000. If income from house property and income from other asset are not separable, so income from property and other asset minus tax as income from other sources. For example, total income equal to property income plus asset income. Total income is 2 lakh, so property income 2 lakh, that is asset income plus property income not separable, means then 2 lakh will be taxed under the head income from other sources. In case of subletting, income from subletting is not taxed under the head income from house property. It is taxed under the head income from other sources. For example, Mr. H let his house to Mr. S for rupees 10,000 per month. Mr. S sublet to Mr. D for 15,000 per month. For Mr. H, the income will be taxed under house property since he is the owner. For Mr. S, the income will be taxed under the other sources since he is not the owner and he sublet the property to Mr. D. For example, income from subletting for Mr. S, rent received from Mr. D, 15,000 into 12, 1,80,000. Less rent paid to Mr. H, 10,000 into 12, 1,20,000. So, subletting income will be 60,000. Next, we will see the annual value. Section 23 deals with calculation of annual value. It is calculated by taking into consideration of various aspects like municipal valuation, fair rental value, standard rent and actual rent, period of vacancy and unrealized rent. How to determine gross annual value and net annual value is discussed in the following pages. Exempted house property income. The following are some of the property income which are exempted from tax. First one, annual value of one self-occupied property. Second one, property used for own business or profession. Then third one, property held for charitable purpose. Then property income of a political party. Then property income of a trade union. Next one, property income of a hospital or other medical institution. Then property income of an approved scientific research association. Property income of a local authority. Annual value of any one place of an ex-ruler. Income from farmhouse. Property income of a games association. Next we will see the meaning of various terms under the income from house property. First we will see the expected rent. Expected rent refers to the reasonable rent for which the property can be let out. It is calculated by considering municipal valuation and fair rental value. If the property comes under the Rent Control Act, then standard rent will also be taken into account to calculate expected rent. Expected rent will be calculated as follows. First one, MRV, that is municipal rental value. fair rental value is given in the problem means whichever is higher, that will be expected rent. No standard rent. If standard rent is available, then whichever is less will be taken as expected rent. Then we'll see the fair rent or fair rental value. Fair rental value refers to the rent which a similar property will fit at the same of nearby similar locality. Municipal rent or municipal rental value. Municipal value refers to the value fixed by the municipal or local authority. In metropolitan cities like Chennai, Mumbai, Delhi and Kolkata, the authorities will determine net municipal value after deducting 10% towards sewerage and water tax from the actual municipal value. Then we'll see the standard rent. Standard rent refers to the rent fixed by the Rent Control Act. It is a maximum rent and owner claim from his tenant as rent. When standard rent is applicable for a property, then expected rent will be calculated taking standard rent into consideration. Then we'll see the actual rent. Actual rent refers to the rent for which a property has been actually let out by the owner. Amount in excess of period of vacancy and unrealized rent should also be taken as actual rent. Given actual rent less period of vacancy less unrealized rent will give the actual rent to be considered. Next we will see gross annual value. Gross annual value refers to the value which is calculated after considering the following: expected rent and actual rent. It is a gross amount which the owner received before allowing any deductions. Next we will see net annual value. It is the amount available after deducting municipal tax or local tax paid by the owner from the gross annual value. It acts as a base to calculate standard deduction under section 24. Next we will see the unrealized rent. Unrealized rent refers to the rent which has not been realized by the owner from the tenant for the let out period. For example, if a property has been let out for a monthly rent of 2000 rupees and the owner has not realized rent for 2 months, then the unrealized rent will be 4000. Unrealized rent should be deducted from actual rent while calculating gross annual value. Then we see the vacancy. Vacancy refers to the period for which the property is not occupied by anyone. The period of vacancy may be at the beginning of the current previous year or at the end of the current previous year or in the middle of the current previous year. This period should be treated as vacancy and the rent for the same should be deducted from actual rent while calculating gross annual value. Next we will go for the self-occupied house. Self-occupied house refers to the house which has been occupied by the owner himself. The owner can claim nil gross annual value for one self-occupied house. It is not necessary that the owner should occupy only one house. He can occupy more than one house, but for tax purpose, only one house will be considered self-occupied. The choice of identifying self-occupied house is left to the discretion of the owner. Usually, the house that has high gross annual value will be considered self-occupied house. Let out house. It refers to the house which has been let out by the owner to the tenant. There is no restriction as to how many houses can be let out. The owner can claim all deductions. There is no restriction on the amount of deduction that can be claimed. Municipal tax, standard deduction and interest on borrowed capital are the deduction which can be claimed by the owner. Next, deemed to be let out. This type of house has the same treatment like let out house. If an assessee, that is owner, has more than one house as self-occupied, then he can select one house as self-occupied house according to his choice. The remaining house will be treated as deemed to be let out houses. Then partly let out and partly self-occupied house. If a part of the whole house is let out and the remaining part is occupied by the owner himself, then it is partly let out and partly self-occupied house. This type of house will be treated as fully let out provided it is not easy to identify the value of each unit separately. If it is easy to identify, then self-occupied will be treated as self-occupied and let out will be treated as let out and property income will be calculated accordingly. Part of the year let out and part of the year self-occupied. If a property is self-occupied for a part of the year and let out for the remaining part of the year, then it will be treated as fully let out and property income will be calculated. For example, if a property is self-occupied for 3 months and has been let out for 9 months, then it will be treated as let out and the income will be calculated accordingly. Next we will see unrealized rent recovered. It refers to the unrealized rent allowed in the earlier years preceding the current previous year, but realized during the current previous year. It will be deemed as income of the year in which it has received. So it will be a deemed income for the current previous year, provided it is recovered during this current previous year. Arrear of rent. When any arrear of rent is recovered during the current previous year, then the excess amount after allowing standard deduction at 30% from such arrear should be taken as income. This income is to be included with the property income. Composite rent. Composite rent refers to the total amount received by the owner towards rent of the property and charges for different services provided such as lift, security, furniture, air conditioner, etc. Composite rent equal to property rent plus rent for previous provisions provided. In this type of cases, the actual amount received for the property should be taken as actual rent, excluding rent for provision charged, provided if it is included in the rent received or borne by the owner to calculate expected rent and gross annual value. Joint expenses. It refers to the expenses that have been incurred for more than one house jointly. Such type of expenses will be apportioned to the respective house as municipal valuation ratio. Now we will see the simple format of house property calculation. First, we will have to take into consideration gross annual value less municipal tax paid by the owner. Then we will get the net annual value. Then we go for the deduction under section 24. Under the deduction, first we go for standard deduction 30% of net annual value. If suppose we have borrowed amount, interest on borrowed capital minus paid or due income from house property should be deducted. Then we will get the house property income. An important note should be noted here. First one, gross annual value is taken as nil for one self-occupied house. Municipal tax paid by the owner is allowed. Paid by the tenant is not allowed. Municipal tax due is also not allowed. Standard deduction should be given for all houses compulsorily except for self-occupied house at 30% on net annual value. It not be mentioned in the product. There are more than one self-occupied house. One house whose gross annual value is higher should be taken as self-occupied and all other houses as deemed to be let out. Joint expenses should be separated on municipal valuation. Municipal tax is to be calculated on percentage basis. It should be calculated on municipal valuation. For self-occupied house only, interest on borrowed capital is allowed. Self-occupied house will always show loss of house property income. Then, how to calculate gross annual value? Calculation of gross annual value. When there is no actual rent and when there is actual rent. First we will see the when there is no actual rent. Calculation of expected rent, that is equal to gross annual value. First we will see MRV, FRV, that is municipal rental value, fair rental value, whichever is higher. There is a standard rent, then whichever is lower will be called as expected rent, that is gross annual value. Then when there is actual rent, calculation of expected rent. First case, MRV, FRV, whichever is higher, there is standard rent, whichever is lower, that will be the expected rent. Comparing, second one, compare with expected rent with actual rent. If actual rent is greater than the expected rent, then what will be the gross annual means? Gross annual value equal to actual rent. Second, actual rent less than expected rent. Then there is a three reason. First reason, because of vacancy only. In that case, first one, expected rent minus vacancy, then actual rent minus vacancy, gross annual value equal to whichever is higher. Then B, because of vacancy and other factors, gross annual value equal to expected rent minus vacancy allowance. Then third one, because of other factors, gross annual value equal to expected rent.